Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. Great to see you, Mark.
Good to see you, Carrie.
Mark, let's start off with the most pressing issue in the news. Russia's invasion of the Ukraine has progressed well beyond the Donbass region, which was originally expected. And as you can see in the visual provided here, ground troops have penetrated the northern border adjacent to Belarus and the coastline along the Black Sea. It's rather clear that Russia is targeting the capital of Kyiv with an objective to ensure the Ukraine does not become an ally to the US and a member of NATO. The US and many other countries are supporting the Ukraine through economic sanctions, weapons, and even troops in Eastern Europe. So as the world is watching, how are the global markets reacting?
Yeah, it's an amazing event, something that we never wanted to see and never expected to see, one of the largest military events really since World War II happening in Europe. And the markets, as you might expect, are unsettled. They're volatile. Interestingly, as we approach to 2022, the hope was that the end of the pandemic may be finally around the corner and that markets may be able to finally recover. But the rising geopolitical risks are making that all change, right? So what we are seeing is markets down across the board. We have here some representative indexes that we always follow. The gray bar here is the bond market. So that is down by 3%, but that's holding up okay relative to some of the other parts of the market. One major index we look at is the S&P. It's down 8% through the end of February. But interestingly, international markets, emerging markets are down less, despite the fact that that's really where the concerns are today with Russia and Ukraine. Very interestingly, too, I look at the dynamics of the market, and the leadership on the way down this time is on the growth stock side, which has traditionally been, at least the last couple of years, been where people have put money for safety. Those are large cap technology companies making lots of money. But what's happening today is that it's the value side of the market, index constituents like energy, materials, other commodities. Those are holding up a little bit better because of the nature of the conflict in Ukraine. And so we're watching the markets very carefully. One final comment I'll make on the market environment is that there has been a flight to safety to some degree, and we've seen that in the bond markets holding up as expected, being the place where people are putting money, at least in the short term.
Now, two of the biggest economic concerns remain oil prices and inflation. Specific to oil, Russia is the second largest producer of oil and natural gas, in addition to many other commodities such as wheat and fertilizer. It seems logical that the disruption in the supply of oil and other agricultural commodities is going to cause prices to increase and drive inflation even higher.
You make a great point. I think the issue with the commodity market, the oil prices, really front page news this particular week. In fact, oil prices have already been we're already rising at the end of last year in anticipation of a market reopening, right? But now this has pushed prices even higher. In fact, not only are they approaching $100 a barrel, but reached that this week. And, that is clearly a concern on the disruption of supply potential with Russia, as you might rightly point out, a big supplier of energy to Eastern Europe and to Western Europe, to be honest, Germany and others. So this is really a feature of the market that we haven't seen in a couple of years. You can look at this chart. We have Brent crude, which is the oil price traded and priced in dollars, but for European oil, and WTI, which is sort of the American equivalent oil price. And both are rising. They're rising from a very low point back in 2020 in the midst of the pandemic, because obviously if there's no travel and no activity, oil prices drop. But going from about $20 a barrel to well over $100 a barrel in the last year and a half, that's a pretty big shock to the system. I think the increase in some of these commodities is clearly inflationary and feeds into the concerns that many market participants had in terms of, well, if we're coming out of the pandemic, aren't we going to demand more energy? That puts pressure up on prices, and that's inflationary. And we're seeing that today. So does that change what the Fed is going to do this year with respect to interest rates? Because they were always going to be increasing interest rates to address the inflation concern. Now it got a little bit more difficult. So we do expect the Fed to continue to move forward as they were going to anyway this year in terms of raising interest rates. As Fed chairman came out recently and said a 25 basis point raise is likely in March. The final thing I'll say on this slide, but the reflationary trends that we did identify at the end of last year, the opening up of the economy, are really still in play today, but maybe a little bit more accentuated because of this particular conflict.
So do the events of the last few weeks change our outlook at Wescott?
Yeah, it's a good point. I think the important thing in here is to look at, well, what were we expecting this year anyway? Despite this conflict, which is still ongoing and could persist for some time, we do expect the U.S. consumer spending, as we talked about before, the economy is still doing okay in the U.S. And that consumer spending should shift from buying goods primarily to buying services primarily. And that, I think, is a help to this inflationary pressure that we're seeing, at least on goods inflation. But it doesn't help much in terms of energy inflation, obviously. So we got to watch that aspect too. The pandemic restrictions are easing. We're seeing mask mandates being changed and dropped in many places. That should support global growth and continue to support growth this year. And we still see that happening. Inflation, maybe it's a little stickier than we had hoped. Maybe it's a little higher for longer. But once the initial shock, I think, of the conflict over time decreases, then I do think that inflation will moderate in the future. And the Federal Reserve will still have to start, though, their increasing rate program because really it's the underlying economy in the US and globally that will likely continue to recover this year. And I think it's important for anyone getting concerned about the volatility is to look at history. History does suggest that a patient approach during periods like this is the best way to maintain your discipline and keep committed to the long term. As you know, Wescott balances portfolios for clients, and the volatility in the equity market is supported and complemented by some stability, we think, in the bond market. And having a balanced approach makes a lot of sense, particularly given the fact that geopolitical risks like this tend to be short-lived, at least in the market.
Terrific. Thanks for the update, Mark. If you have questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. And thanks for your trust in Wescott.